I'm Krishna and welcome to Who Said What. I saw all the comments last time telling me to stop making jokes about losing my job. Fine, I'll stop. I'll find something else to joke about. Anyway, in this show, I dive into interesting comments made by notable figures from across the world, whether it's finance or the broader business world, and dig into the stories behind them. Today, I have 5 very interesting comments for you from the last week. In the first story, I'll talk about FIIs in India. Samir Arora, the CEO of Helios, recently at an event said something about FII investments that everyone, and by that I mean the finance Twitter crowd, has been talking about. So here's the situation. India imposes a 12.5% long-term capital gains tax on FIIs. Samir Arora called this policy 100% wrong, arguing it's a critical mistake that could be hampering India's investment growth.
India takes 20% or 15% tax and it cannot be recovered. Reality is that they have to accept that the capital gains tax in India, particularly for foreign investors, is 100% wrong.
See, I've touched upon this before, but this time around, Samir brought in even more nuance and detail. So what is he exactly saying? Let me break it down step by step. First, Arora claims India stands out globally for taxing foreign investors on capital gains. He uses the phrase 199 out of 200 countries to emphasize that almost no one else does this.
UK, by the way, there are some 200 countries in the world. 199 of them there is no tax for a foreign investor.
Now, is it literally 199? It's tough to verify, but you get the point. India's policy is unusual compared to international norms. Second, the investors facing this tax include major sovereign wealth funds like GIC of Singapore, pension funds like Norway's government pension fund, university endowments, and high net worth individuals living in low tax places. Now, why is all of this a problem? According to Arora, these funds are typically tax exempt at home, so they pay zero capital gains tax when they invest in markets like the US. But in India, they get slapped with a high tax. Even worse, they can't offset it against any taxes back home because, well, there aren't any.
It's just easy to say, oh, you are paying it here, but you can recover it in your home country because you can set it off. There is no tax there. What to do? These guys have no tax in their home country. And they are, whether you like it or not, 60-70% of the money in the world.
Next, we've got the math issue. See, if these investors earn 10% in rupees and then the rupee loses about 5% against the dollar return is already down to around 5%. Then you apply the capital gains tax. This brings the net gain down to about 3 to 4%. In a world with many more attractive investment destinations, that's a tough sell. He also looks at the big picture of what India actually collects. From 2022 to 2023 fiscal year, India brought in roughly 99,000 crores from all capital gains taxes. In weaker years, however, a lot of this was offset by carry forward losses.
India got 99,000 crores as capital gains tax, which is $10 billion, let's say $11 billion.
Over a 5 to 7 year cycle, he estimates that maybe $3 to $4 billion per year actually sticks as revenue from foreign investors. So his question is this: is it worth pulling in a few billions in taxes if it potentially scares away much larger pools of global capital? See, FIIs matter to the larger ecosystem. Here's what Samir Arora makes a deeper point about how different parts of the investment world fit together. FIIs might seem like short-term traders chasing quick profit. Private equity or PE, which does create jobs and brings in technology, needs a healthy market with plenty of buyers to exit its investments. Those buyers often include FIIs who bring the dollars needed when PE firms cash out. If FIIs are discouraged, PE investments become riskier, and that could reduce the flow of money that actually helps build companies, create jobs, and foster tech growth in India. In his words, we like private equity because they create jobs, they bring technology, but if they don't have an exit, they can't sell it to all the domestic mutual funds.
अलग से आप करो, अभी like private equity because he creates jobs, they create technology, but if they don't have an exit, or if their exit needs dollars, they can't sell it all to domestic mutual fund, even if there is money.
In other words, it's one giant interconnected web. Deepak Shanoy is on board with removing the tax but frames it in a slightly different way. He says India has reached a point where quirky, non-standard tax might have been fine when the country was smaller, but at scale, it's a pain. Now, what does this translate into? As India grows into a major global economy, the old rules might be holding it back. What once worked in an emerging market might be out of place for a soon-to-be economic powerhouse. Now, not everyone agrees with Samir Arora. Some people point out that investors seemed fine paying these taxes before. So, if India remains a hot market, what's stopping them from coming in anyway? Now, this raises the question, does India need to conform to global norms to attract capital, or does its growth story stand on its own? And it is fair to change the rules for those who have already been investing, possibly on less favorable terms. Now, let me take a look at the historical background. Samir Arora has been sounding the alarm since 2018, saying this was bound to affect foreign flows over time. He also notes that capital gains tax for FIIs was zero before 2018. When the government introduced STT or Securities Transaction Tax years ago, it was meant to replace capital gains tax. But now foreign investors face both, essentially double taxation from their viewpoint. Now, what's the bottom line of all of this? First, as India rises to become the world's third largest economy, do this tax policy set in different era still make sense? Second, India's government has to weigh the tax revenue it earns against potentially massive investment flows that can fuel startups, infrastructure and long-term economic growth. Third, changes to how FIIs are taxed ripple through private equity, job creation and even technology transfer. At the end of the day, should India align with global standards that generally don't tax foreign capital gains, or keep its own approach because it's worked so far? Now, all of these are strong opinions on both sides, and it's not a trivial choice. This is the full story behind Samir Arora's comments. Do you believe India should drop the capital gains tax to attract global money? Now, in the second story, I'll look at some comments made by Samit Vartak of Sage One Investments recently in an interview to NDTV Profit. He touched upon a bunch of interesting things. He says, it's always good to have too many worries around you. That's where you find value. He points out that every 3 to 4 years, markets typically go through a sale, a correction that often starts when sentiments gets really negative.
I mean, it's always good to have too many worries around you. That's where you find value. And so I look at it as a cyclical, it's like almost like an annual sale. Or sometimes there is one big sale which happens every 3 years or the 2.5, 4 years. That's a very, very common timeline.
According to him, the correction that began around September 2024 is following this 3 to 4 year pattern, and corrections usually last about 6 to 9 months. In fact, when they are sharper, they often don't drag on as long.
That you will never get such a big sale unless there are warning signs around you. So I feel happy if there are too many people warning against it. That means that the weak hands can't withstand such warnings. Only the strong hands will withstand.
Samit says he's actually happy when everyone else is worried, because that means weak hands can't withstand such warnings. Only strong hands will. In other words, the more negative the headlines, the bigger the potential discount for investors. Now, a lot of people assume large cap stocks are cheaper than mid or small caps, but Samit challenges the idea by taking a closer look at valuation metrics. He had tweeted about this earlier and I had covered this in one of the previous episodes, but let me go over it again. In his post, he dissected how valuations for different market segments, large cap, mid caps and small caps, can often be misleading. He pointed out that PSUs and banks generally trade at lower PE ratios, and because these stocks make up a larger chunk of the large cap universe, they distort the weighted average PE multiple. His key argument is this: using broad PE ratios to compare large, mid and small caps is like comparing apples to oranges. Now here's where things get interesting. He argues that in large caps, PSUs contribute 33% of total profits, while in small caps, their contribution is only 9%. The weighted average PE of large cap universe is 21.6 compared to 29.9 for small caps. But if you strip out PSUs and private banks, the median PE for large caps jumped to 42, while small cap drops to 33.3. This flips the entire valuation debate on its head. The popular narrative right now is that small caps are widely expensive, but if you adjust for composition, they may not be as stretched as people think. Now, coming to the liquidity factor. Have you ever wondered why good stocks also fall during a market sell-off? Samit argues that it's often liquidity and not fundamentals that drive these short-term moves, especially in the small and mid-cap space.
So when liquidity comes out, good, bad doesn't matter. everything falls.
Smaller companies feel the pinch more because it only takes a few sellers with no buyers on the other side to drive the price down sharply. Ironically, this is where the opportunity lies. When there's liquidity, vacuum, you can pick up quality stocks at cheaper prices. What sets Samit apart is his systematic approach to finding multi-baggers, stocks that can grow 10x or more. He studied companies that deliver 10x returns from the 2008 market peak to see what made them tick. Here's what he found. First, higher sales growth, 15% versus 10% for non-multi-baggers. Second, higher starting ROE, 25% versus 22% and a more sustainable ROE over time. Third, lower starting valuations. They were 15 to 20% cheaper. Fourth, smaller starting market caps, around 3,400 crores versus 10,000 crores on average. He concludes small caps have double the profitability of becoming multi-baggers compared to large caps, and a big reason is simple math.
Fine. Imagine like the smallest large cap today is 1 lakh crore.
Yeah.
Right? If that needs to go up 10x in 10 years, that will be 10 lakh crore. Right? That company will be in the top 10 or top 5 companies
Most
of India.
certainly.
What is the probability of that?
Yeah.
The smallest large cap cannot, become a 10 bagger.
10x.
It's mathematically impossible.
Yeah, almost
unless it's a completely outlier.
Now, there's a common narrative that private capex in India is weak. Large industrial players in cement or steel aren't expanding aggressively right now. But Samit sees another story playing out in quality small caps. Most of the good quality small cap companies I know are in the middle of a massive capex cycle. Many are doubling their capacity over the next 3 to 4 years, he says. These expansions are small from a macro perspective, so they don't need to move the needle in national statistics. But for investors, those capacity increases can be huge drivers of future growth. Now, talking about portfolio drawdowns. Now, if you're an investor watching your portfolio drop 20%, 30% or even 50%, Samit offers a practical advice. First, he says pretend you're starting afresh with new money rather than fixating on losses. Second, if you're sitting on losses, this can be a smart time to swell, reduce your tax bill and reinvest in more attractive opportunities. He reminds us that the quality companies can bounce back quickly when the market turns. For example, small caps fell 70% in the 2008 to 2009 crash but recovered 3.5 times in just 14 months, basically regaining all their lost ground. But a word of caution, 70 to 80% of stocks that soared in bull run might never see those highs again for years. Finally, Samit underscores the importance of patience, especially in small cap investing. He says there have been periods in history, 4, 5, even 8 years where the market delivered no returns. If you are investing in small caps, you need to look beyond just the next 12 months. This long-term lens helps him stay focused on companies with sustainable ROEs and market share gains. Sectors rise and fall, but a company growing its market share can thrive even when the broader space is struggling. Samit's big takeaway is this: don't just chase hot sectors. Look for companies that consistently grab market share because that often drives resilient ROE and growth over the long haul.
That market share gain, I think, is one of the most resilient factor for sustaining ROE as well as resilient growth, because those players tend to grow during ups and down cycles.
Yeah.
Whereas if you're just betting on sector play, you're completely riding the bull cycle of that sector.
Now for this segment, I've gathered comments from a bunch of different people in the markets. Samir Arora, Samit Vartak, Ramdev Agarwal and our boss Nitin Kamath. Let me start with Samir Arora, who looks at past market cycles and sees a pattern.
So if you see 2000, 2008, mota mati they last 8-10 months in which they fall a lot or whatever they have to fall. And then they hang around for 3-4 months and then new round happens. So if you look at it like that, there is another 1 or 2 months.
He points out that our current correction began in September 2024, which means we are about 6 to 7 months in. If history is any guide, we are possibly nearing the tail end of the most severe phase. Samit Vartak adds a similar time frame but explains this further.
I think so. This is definitely, last correction we had started in December 21 and it continued towards 22, probably half of the year. And then 3 years down the line, again, September 24, is when we had the peak in the market. So we're already there, 5-6 months. And generally, I've seen that the average duration of correction is that 6 to 9 months. Right? And the faster it corrects, the shorter is the duration.
Meanwhile, Ramdeo Agarwal frames this as a healthy, even expected correction.
If we are there for 6 months out here, last year we made 50% in the market, broad market I'm saying, and we have lost say 20-25%. So I think it is painful, I understand, it is painful to me also, but it is very, very logical. I mean, it's a proper healthy correction,
For newer investors like me, especially those who started investing after the pandemic, Nitin highlights that this is the first real correction. He says, markets are cyclical, and given the way our markets went up from late 2020, this fall was inevitable. He said one more thing. He recently tweeted that this is exactly why SIPs matter. He said, what an SIP helps you do is average out your investments across different market cycles. You averaged on your way up from 2021, now you get the average on the way down. And if you are looking for more on that, Bhuvan from the team wrote a long blog post on how to deal with bear markets. He said this, historical data suggests that SIPs which delivered comparatively lower returns in the initial 5 years have delivered better returns on a 10-year basis. During the 2020 COVID crash, large, mid-cap and small caps fell by 25 to 40%, but then they rose by 200 to 400%. If you had panicked, you would have missed the rebound. When it comes to how deep this correction might go, we see some differing views. Ramdeo Agarwal feels large caps might already be close to their fair value.
The P multiple which was at 23, 24, that has come down to less than 20. And it is at below 10 years average. So nothing stops at the average. It overshoots a little bit. So that is what is on now. If market corrects further from here, it is overshooting downside.
However, he does think mid and small caps might need more time.
On same 5-year basis, mid cap is up 177, 180%. So the gap is too much. If it was at about 100, 110, that I understand. So that excess gain, either large cap has to catch up to match mid cap, or mid cap has to keep correcting, time-wise or actual downfall.
Samir Arora isn't 100% sure if we have hit the bottom yet, but believes that economic triggers, not just the clock, will mark the turning point.
By April, May, time also would have been 8 months, say September, say October, say. And second is, by that time, this situation of Trump and negotiations would also end. So if you are very market-oriented, you'll say these falls take 8 months. If you are very macro-oriented, you'll say we are waiting for Trump uncertainty to end.
Now each expert has a different take on what could spark the market back into rally mode. Samit Vartak believes no matter when the broader market recovers, returns will largely come from quality companies.
I don't know what will happen in the next 3 months or 4 months, but I'm pretty sure if you are a good stock picker, from a 3-year perspective, there is exciting opportunities, and it will be shocking to me if you can't make money over a 3 to 4 year period.
Ramdeo Agarwal points to earnings growth and the supply-demand balance returning in equity markets.
And your IPO markets are now shut, almost like frozen. So one by one, right things are happening. Credit flow is improving. Government expenditure is picking up. So I think all the things are falling in place, and correction has also happened.
So what's the takeaway? Here are a few recurring themes that I see. We are likely in the later stages of the correction, 6 to 9 months in. Mid and small caps may still need extra time to correct. Quality companies with strong fundamentals will likely recover the fastest. Now, for the fourth story, Manish Dangi, founder of Macro Mosaic Investing and Research, in an interview with NDTV Profit, spoke about the global macro picture. He sees Trump's tariff policies not just as short-term negotiation tactics, but as strategic moves in global chess game. According to him, the man is more ideological today than he was in the first term. He is more determined, has less worry of its impact. In other words, Trump is less concerned now about how tariffs might rattle equity markets compared to his first presidency. Dangi then delivers a surprising perspective on tariffs and inflation.
At margin in US for the first order is going to be inflationary, but eventually the growth actually takes a bigger hit, and which is why typically when big tariffs sort of are imposed, eventually paradoxically rates actually come down. They don't go up in US.
He says currency adjustments will absorb much of the inflationary shock. If the dollar adjusts and appreciates, the TV and the fridge that they bought from China pretty much cost the same. So while tariffs can spark prices initially, the stronger dollar could end up stabilizing US consumer costs even if overall growth slows down. But what about the rest of the world? He warns that emerging markets like India could face serious fallout.
Neeraj, is actually what tariffs do is to the outside world, and which is an out and out malignant. You get my point. The impact of this actually to the outside world is substantially more, because for us the only risk currency is dollar. There is absolutely no way that dollar strengthens and India has a reflation.
In simpler terms, a rising dollar makes life tough for emerging markets because it tightens financial conditions and choke off growth. He also points out to USD strength as a key signpost. If you have nothing else to sort of track in terms of risk on, risk off, just the USD movement itself is almost a very cool indicator. Many people on the street are banking on foreign investors to bounce back into Indian markets after the recent sell-off, but Dangi isn't convinced.
I've been a FII pessimist for many, many years, Neeraj. We've discussed about it that, given demographics in US, this case of FII money on a secular basis coming in ended in 2010s, early 2012, 13, 14. After that, on net basis, FIIs come and go.
He suggested that India evolved to a point similar to South Korea in 1990s, where domestic capital is robust enough to drive the market without relying on foreign money. This is good news in terms of self-sufficiency, but it also means we shouldn't expect those big waves of foreign investment we once saw. Another curveball Dangi throws into the mix is China's potential resurgence as an emerging market favorite.
Is that there is seriously a case of one, US-China sort of cozying up, two, China actually entering in the so-called tech world with sort of a full fanfare, and actually can potentially threaten both US's hegemony, but Indian hegemony in emerging markets, that we are the only play in the ground.
He speculates that improving relations between the US and China could unlock hundreds and hundreds of billions of dollars in Chinese markets. With China appearing cheap, showing signs of recovery and poised for possible fiscal stimulus, international investors might just decide to park their money there instead of India, especially if Beijing is no longer threat as a global outcast. Now you often hear analysts say that valuations are so attractive now that alone should bring investors back in. He pushes back on this idea.
Neeraj, valuations don't have muscles to lift markets. It kind of perhaps is a lubricant. It can almost assure you of good returns if you actually buy cheap, but it doesn't have the muscle.
Simply put, prices might look attractive, but without a real catalyst like strong earnings, policy shifts, or global tailwinds, cheap stocks can stay cheap for a very long time. As he bluntly states, never buy cheap just because it's cheap. Another key concern that he brings up is corporate profit margins. He points out that equity valuations don't add up if margins start sliding.
Frankly, at 9-10% of nominal GDP growth or 9-10% of credit growth at 20 times, it's sort of equity math does not add up. On top of it, you have to accept the fact that the margins haven't rolled over yet.
He compares the current situation to 2009 to 14 when India's historically high returns on equity took a nosedive. We were all wondering as to why this country that was delivering 20 to 25% ROE in 2000s was barely scratching the surface at 12 to 14%. It's a warning that past performance doesn't necessarily repeat if fundamental drivers like global conditions, corporate profits, and currency dynamics aren't in place. Now, the final story. Ray Dalio, the legendary investor, made some comments about America facing a potential fiscal heart attack and his suggestions about gold as a safe haven. He spoke about this on Bloomberg's Odd Lots podcast. He was there to discuss insights from his new book, How Countries Go Broke, Principles for Navigating the Big Debt Cycle, a deep dive into how debt builds up and what happens when it gets too big to manage. The soundbite causing a stir is Dalio saying something like this.
That I'm saying will come. And I can't tell you exactly when it'll come. It's like the heart attack. I can't tell you exactly. You're getting closer. My guess would be 3 years, give or take a year, something like that.
He compared this looming crisis to a heart attack. You never know exactly when it will happen only that the underlying conditions mean it's likely. And then there was another quote about gold.
Yes. I think that gold, and I'm not trying to harp on gold, and I don't want people to run out and go buy.
They will, though. They will.
Now you might think he's calling for an imminent financial apocalypse and telling everyone to buy gold tomorrow morning, but let's see what he was really saying. See, Ray Dalio isn't just some random YouTuber talking about finance. He founded Bridgewater Associates, one of the world's largest hedge funds, and he studied how economies behave over centuries. So when he talks about fiscal heart attack, he's not throwing around buzzwords. He's drawing from decades of research on what he calls the big debt cycle. See, the US currently has significant debt problem. The budget deficit in 2024 was around $1.8 trillion, which is roughly 7.5% of GDP. Interest on the government's debt is around $1 trillion per year. Plus, US is constantly rolling over old debt while issuing new debt to cover the growing deficit. Dalio's argument is that we have reached a point where we have so much debt relative to income, both at a government and individual level, that we are at a risk of crisis if investor demand for US government bonds dries up. In his view, one person's debt is another person's asset. But once there's too much debt, confidence can wobble. If demand for bond weakens, the Federal Reserve usually responds by printing money to buy these bonds, devaluing the currency in process. That's the heart attack analogy. Too much plague in the system eventually leads to something big and ugly. Now Dalio isn't just out here screaming doom. He has a proposed fix he calls the 3% pledge, meaning the US should aim to bring down the budget deficit down to 3% of GDP, about half of where it is now. He cites the period from 1992 to 1998 as a real-world example when this was achieved. He also says fiscal tightening needs to happen alongside some monetary support, striking a balance between trimming government spending or raising revenue and not letting the economy collapse from a lack of stimulus. About gold, Dalio wasn't giving a blanket buy now command. In fact, he explicitly said he wasn't trying to harp on gold, but he acknowledged that in the kind of crisis he is describing, where currency is devalued, gold historically performs well. He suggested a 10 to 15% allocation might be wise for diversification. He even mentioned Bitcoin could serve a similar purpose alongside gold as a sort of insurance policy when people lose confidence in fiat currencies. What's really worth noting is Dalio's method, historical analysis. He said his perspective on markets changed in 1971 when President Nixon took the US off the gold standard. Rather than the panic, he studied how similar movements played out before, like what Roosevelt did in 1933. That approach helped him anticipate events like 2008 financial crisis. In his latest research, Dalio uses a risk gauge to illustrate where the US stands. He says long-term risk gauge is at 100%, meaning vulnerabilities have piled on over decades. But the short-term risk gauge is at 0%, meaning there's no immediate obvious trigger for a collapse. That's why he uses the heart attack analogy. You know the arteries are clogged, you just don't know the exact day the heart attack might happen. This is the nuance that often gets lost in the sensational headlines. Yes, Dalio says a big crisis could happen in the next few years, but the main takeaway isn't run for the hills. It's understanding how debt cycles work and how to manage them. Whether you fully buy into his timeline or not, Dalio's broader point about fiscal sustainability is worth a closer look. That's all for this episode. Thanks for tuning in. If you have any feedback for me, please let me know in the comments below. Start. टेढ़ा हो गया. थोड़ा सा ऐसे कर लो. एक मिनट. सर एक मिनट. Potentially. अरे यार क्या बोल रहा हूँ? 5 मिनट ब्रेक दो. मेरे को पता नहीं है क्या बोल रहा हूँ. एक मिनट ऊपर जाना. 1 मिनट पॉज करना. 1 मिनट. 1 मिनट. हाँ सर.